Good afternoon, everyone, and thank you so much for joining today's webinar. We're diving into so many exciting topics, namely pension planning, ISAs, and the upcoming end of the non-DON system in the UK. With us today as Brian, as always, and Alex, who's our Director of Strategic Planning. As usual, if you have any questions, please leave them in the chat as we can answer them in the Q&A at the end. Before we begin, here's a quick disclaimer note. The information presented is for educational purposes only and does not intend to make an offer or a solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategies discussed herein. So with that being said, I'm going to pass it over to Brian and Alex.
Thanks so much, Paulina. And Alex, welcome. This is your first webinar that you're doing with us. First of many.
It is.
The UK changed a lot since October, but certain things are nomers. We want to make sure we cover a lot of these different territories and a lot of these acronyms and words that might be foreign for us American expats. So should we dig right into some of those?
Sure. So we're going to talk today a little bit about pension planning, as Brian noted. So for me, the first place to start is to talk about ISAs in the UK for American citizens. So ISAs are individual savings accounts that allow for tax-efficient saving and investing. They're basically a wrapper around a savings or investment account. So your interest, your dividends, your capital gains are exempt from income tax and capital gains tax. And you have contribution limits every year of 20,000 British pounds, that is. And there are issues that one needs to address if one is an American in ISAs. So the first one is PFICs. So Brian, would you like to talk a little bit about PFICs?
Well, Alex, you get a four-letter acronym and all of a sudden you associate it with me. The easy way I like to think about any of these four-letter acronyms is your mom didn't let you use four-letter words when you were a kid. Your accountant doesn't let you use four-letter acronyms. PFICs are passive foreign investment companies. And passive foreign investment companies essentially become a mess on the US side because you get either a rock or a hard place, i.e., you're either getting taxed badly or taxed in an impossible way. Either way, it's going to be more expensive to file on an annual basis and probably more expensive to do your taxes. So what is it actually? Essentially, any construct that's over 75% foreign made up is considered a passive foreign investment company, which means every investment vehicle that's managed outside of the United States, whether it be a UCIT, even an exchange traded fund UCIT that's in the UK, will be a PFIC, and therefore be taxed in a negative way in the United States, even if it's tax effective on the UK side.
And the taxation is really important to point out because in the US, the IRS is basically not recognizing an ISA as a qualified fund. So as a result, these investments, these PFICs, can be taxed up to 100%. There are ways to offset that. You can make qualified electing fund elections. But there's such complex rules, and it's going to increase the cost of your tax filings. So generally, it's considered best to try to avoid those things when investing.
Absolutely. So that means essentially we need to actually buy those collectives in the United States, but that's where the FCA gets in our way. The UK regulators state that an ISA cannot have any foreign investments, i.e. foreign to the United Kingdom. So We can't buy US ETFs or managed funds, mutual funds. We can't buy UK managed funds or the such. So can we buy an ISA?
Well, the answer is yes, you can, but you have to be a little bit more careful about your compliance on the US side, and you have to be a little bit more careful about what kinds of investments you put in these structures.
We have a few options in there. The first option is a cash ISA. Now, Alex is our lead financial planner in these types of areas. And what are your thoughts on a cash ISA?
Well, they can be a good vehicle, but of course, the one thing that you have to worry about in a cash product is you're not keeping up with inflation if you're keeping your funds entirely in cash. That's the main problem.
Absolutely. And I think of it in more of an algebraic type of way, i.e. you have your order of operations. When we take distribution of funds, we have an order of operations. And anything tax-free, so those Roth IRAs are going to be the last place that I take money from. Since ISAs are taxable in the United States, but not in the UK, i.e. they're lower tax than regular investment accounts, they're going to be higher up on the list. Now, that essentially means I want to go ahead and have money invested inside of an ISA that's going to grow higher and faster than, say, in a fully taxable account, because then I'm not going to get as much of a ding on there. So it's building all of your investments into one view of your financial plan instead of, oh, I can just do a cash ISA. So what is that? Sorry, go ahead, Alex.
I was going to say, so the question stands, what's the benefit for an American living in the UK to invest in an ISA?
Well, the benefit is simply increased after Rachel Reeves' budget last year. Before, it was only a differential of 20 to 15% between the US and the UK. Now it's increased significantly to where you're nearly saving half of the tax by putting it into the ISA wrapper. And you're just playing tax arbitrage by being taxable in the US instead of being taxed in the UK. So it is a very, very helpful function, but it's not for everybody. If we're going to build investments in there, we're probably going to have a group of 30 or 40 individual stocks. And 30 to 40 individual stocks might not be as much diversification as somebody needs inside of their portfolio. So works well when somebody has a higher net worth, and that's just a small part, that 20,000 pounds. But that typical new saver that's just putting away their first bit, it might not be the best way, i.e. first create the tax problem before you fix the tax problem. If you're putting away $1,000 a month, then pay that little bit of tax on it to have it in a GIA and have more diversification through exchange traded funds, and know that the ISA is going to be an opportunity later on.
Absolutely. So any further thoughts about ISAs?
Well, I think the main place with the ISAs is it has a place in the financial plan, but it doesn't have to be part of everybody's financial plan. It should be part of everybody that's not American's financial plan in the UK. Once you move out of the UK, if you move back to the States, don't close out your ISA unless you know you're definitely not coming back to the UK. So you move back to the US for 5 years and you're coming back to the UK, keep that ISA. It's fully taxable in the US. So keep it as part of a cross-border plan until you know you're not going to be coming back in any way, shape, or form.
So should we move on and talk about the changes that have occurred since April regarding the non-dom regime?
Oh, we got tons of changes, don't we? And then we
We
got changes
do.
in the Oh, nothing but change going on this year.
Yeah. So the big news, the big headline news here is that in the autumn budget of 2024, the UK abolished the non-dom regime. So what does that mean? That means that if you were considered to not be domiciled in the UK, so in other words, you had your permanent home outside of the UK, you didn't used to have to pay UK tax on foreign income or capital gains. So the test there was if you actually took the funds from whatever foreign location they came from and brought them to the UK. They call that remitting them. So it used to be that you were taxed on a remittance basis. Just whatever you brought over was taxed. However, in the autumn budget, they abolished this regime. So now the UK is moving to tax foreign income and capital gains on a worldwide basis. And that is that there are rules to this that we can discuss. But basically what it means is that you're going to have to think about your domicile, how long you have been in the UK matters, and what types of assets and what types of structures also matters. So, Brian, would you like to elaborate on that?
Well, I have a follow-up question. Are there exceptions of time periods if you first get directly over here to the UK? Are you subject to the UK taxation right away?
No, under this new regime, which they're calling the FIG regime, the foreign interest and gains regime, for the first 4 years that you come to the UK, your income is UK tax-free, but only if it remains abroad. Your time starts from April 6th of 2025, or from the first tax year in which you become resident in the UK. And it's only available to individuals who have been non-UK resident for at least the previous 10 tax years.
So any of us that have already been here are subject automatically to this new regime.
That's the way it works. And they've done this, according to Rachel Reeves, the Chancellor of the Exchequer, they've done this in order to make the rules more fair. So the idea behind this was that people who were resident in the UK but not domiciled here were getting preferential tax treatment.
It was a small crowd. If I remember correctly, I think it was only 10,000 or so that were on the non-dom status.
Yeah, it's not a large number of people, but the people who are in that group are very well, they're ultra high net worth clients. So it does impact them pretty strongly.
I seem to remember a prime minister's wife happened to be on that list, and I think that was one of the controversial ones.
Yes, but there is some decent news in it as well. So they have given a temporary repatriation facility. So if you have used the remittance basis in the past and you have unremitted foreign income and gains arising before the date, this April 6, 2025 date, you could elect to designate all or part of it and pay reduced rates to bring those assets to the UK. So that was part of the package as well.
Oh, perfect. So it's not just all punishment and increased taxes. It's trying to help get things working.
Right. And they also have a rebasing facility as well. So if you have assets outside the UK, they are available to have their capital gains rebased as of the date they used was the 5th of April, 2017. So that also does help a bit. But unfortunately, it's not available for individuals who became UK domiciled before April 6, 2025.
So in other words, you can pick 2017 or the higher limit, or are you subject just?
No, No, the assets are revalued to their market value as of April 5th, 2017. But if you became domiciled in the UK before 2025, unfortunately, it's not available. So that is the flip side to it.
And then would your actual assets have a cost basis of the original purchase value in pound terms or the value that you became resident?
They would have a value as of 2017, the value of that asset on at 2017. So if you purchased assets in the 1970s or 80s and you have a whole bunch of capital gains there, the UK will say, okay, we're going to forget about those. We're only going to look at the gains from 2017 onward.
Oh,
So
that's extremely helpful for somebody coming in with those long-term gains. You know, somebody that bought Apple back in the original days, that's very helpful.
or people that bought a lot of property, that as well could really offset some of those gains.
Absolutely. Absolutely. What other changes do we have going on here in the UK?
Well, still sticking with the non-dom regime, there have been some changes to inheritance tax as well, the way that is being calculated. So instead of being on the non-dom system, the UK has moved to a residence-based system. So IHT, inheritance tax, is being charged on worldwide assets for individuals who've been UK resident. However, you have to have been UK resident in 10 out of the last 20 years. So if you're an expat who's been abroad for 20 years, it's not going to apply. The downside here is that assets also remain within the scope of IHT for up to 10 years following your exit from the UK. So that has to be taken into consideration.
In other words, you're dom here in the UK, and how do you know how they define whether you're still dom here in the UK or whether you've exited the system?
Well, domicile is a tricky concept, but generally it's where your permanent residence is. And that's why they're doing away with it for, especially for capital gains and income, is because they want to move to a situation where it's your residency that's really controlling. But when you look at inheritance tax, there are still some areas where domicile is going to be important, particularly looking at excluded property trusts. But for the most part, it's going to be a residence-based system from here on out.
Which is extremely helpful because it used to be determined that domicile could only be determined upon death, which is hard to do planning if you don't know whether you're domiciled in the UK or not until you've actually died. So you had to come up with finicky ways to be able to test it year after year. So a residency-based taxation system will on inheritance tax will make things a lot easier going forward. But it's still substantially higher than what we're used to in the United States. We still have the 325,000 limit per person.
I think it's 322 to be precise, but and then you get the residence nil rate band of 175,000. It goes some way towards cushioning that blow, but certainly the U.S. has a much nicer regime in that respect.
Absolutely. One thing to remember, the U.S. and the U.K. do have a double taxation treaty, not just on taxes, but on inheritance tax and a totalization agreement. So you want to figure out how it works for Social Security, inheritance tax, and regular taxation. The nice news, not turning this all into a tax segment, all three of them are some of the best that you'll get anywhere around the world between the UK and the US. So you don't want to forget that those are there and they exist.
Absolutely.
Do we want to talk about pensions some, Alex?
Absolutely. So where would you like to start? US, UK?
Well, why don't we start with the nice US IRAs and 401ks and how they behave here in the UK?
Okay, so obviously IRAs, there are several types of IRAs. There are traditional IRAs, which are funded with funds that have not that have been taxed, and then you have Roth IRAs that work as well. And the taxation in the UK, not sure about that actually, Brian.
Okay, well, it looks like Brian is frozen. Are you
All right,
back on?
I'm back.
He's back.
Oh,
Yeah. I'll pop back out.
okay.
Sorry about that, Alex.
Oh, it's all right. So I was just saying there are multiple kinds of pension plans. You can be looking at IRAs, Roth IRAs. You have all the governmental plans, 403Bs, 457s. Then, of course, you have your workplace pension plans. Sometimes you see defined benefit in the US, not as much anymore.
Yeah.
Yeah, I mean, sometimes you'll come across someone that has one, but they're very expensive to administer, and they've really fallen out of favor. But there's a whole range of 401ks, profit sharing plans. There are quite a few of them on the US side.
Now, I like to separate the government plans in the US from the private plans.
Mhm.
Main reason why, what I find is a lot of government workers accidentally roll their government plans into an IRA, and they lose some of the best benefits that the double taxation agreement offers them for their underpaid and overworked careers. The nice thing that the UK gives these individuals is that they let them be taxed fully in the US on those government plans. So if you roll them over to an IRA, it's going to be taxed as a regular IRA in most countries instead of on that US taxation, which can increase the taxes significantly.
Mhm.
So if you're not if you're going to take just a few takeaways, if you're a government employee, make sure you rewatch that part over and over again before somebody convinces you to roll that over into an IRA, or get a tax determination that the IRA is ring fenced and only a government plan. So make sure your tax accountant's on that. With the other IRAs, are there certain advantages or disadvantages of traditional versus Roth? Or should we first describe traditional versus Roth?
Well, there are differences, obviously. A Roth is a specialized type of IRA. So basically, it's about whether the money was taxed when it went into the IRA or not. And so at the end of the day, what you're looking for is you're looking for growth over time in both, tax deferred. And at the end of the day, when you go to take withdrawals, which type of IRA you have will determine how those withdrawals are treated for tax purposes.
And so are Roth IRAs recognized here in the UK?
Well, they are and they aren't. I mean, obviously people recognize them as in they know about them, but as to the tax consequences, that I am a little unsure of.
For the most part, the UK recognizes the Roth. Um, and essentially that means we get some great advantage from it. Um, for the traditional IRA, the one problem is both the US and UK recognize it that you're taxed in the country in which you withdraw the funds from. So in other words, if we build up that traditional IRA in the US, we're going to be taxed a little bit higher once we get over here to the UK on distributions because the tax brackets are that little bit higher. The nice aspect of it is that essentially a US retirement plan works impeccably in the UK just as if it was a UK plan. So there's no interpretation problems of the two programs between the two different countries. Now, if you use the credit system for taxes, you can be eligible to continue to make IRA contributions each and every year. You could even make a backdoor Roth, or just a regular Roth contribution, depending on the different limits. So essentially, you can still build up those U.S. retirement assets each year. The importance is that credit system. I.e., if you're taking that foreign earned income exclusion, do not make an IRA contribution or a Roth contribution or a backdoor Roth, because you will be subject. Is it a 6% excise tax each year?
I believe so, yes.
Yeah, it compounds. It's nasty if you make that mistake. So make sure you're talking to your financial advisor, your tax accountant, to make sure you're filing correctly to make that IRA contribution. Should we shift over to UK pensions?
Yes, we've already discussed the ISAs. So from there, would you like to discuss SIPs?
Yeah, we have our corporate pensions and we have SIPs. So nice big eligibility on a corporate pension, which you can put up to £60,000 away per annum, which most people that call us to get started investing, when they say we're looking to save for our retirement, we'll say to them, you don't need us. You don't need our robo-advisor product in DF Direct. You just need to call your HR department and increase your contributions. I've only had a handful of people that have called up saying, I'm 20-something, I need to send money for my retirement, and I'm already maxing out my £60,000, which is a great problem to have. Then you go to your IRA contribution in the States. But the US and UK double taxation agreement is so good between the US and the UK that when you're putting away money into your UK pension, it is going to be recognized on the US side, and it's going to grow tax deferred, and it's going to lower your taxable threshold here in the UK. So most likely that's the first place to go. Do not make the mistake of only taking the 5% match or whatever it might be. The general rule financial planning, and Alex, please correct me if I'm off on this, is if you save 20% of your income for your entire working career and you don't touch it, you let it grow with the markets, you probably will never actually have to run a financial plan because you'll have enough funds to live the same life living as in retirement. Now, why you wouldn't want to hang out with Alex to build a financial plan, I don't know, but that's the easy remedy. Kind of the apple a day keeps the doctor away. 20% into your pensions will essentially keep the financial advisors away. So very easy metric for when you're first starting out. The problem is typically there's that 5% max, and people put in their 5% and the company puts in their 5%. So don't be scared of that. Increase that. Now, let's just say you're watching this and you're thinking to yourself, I have a lump of cash that I wanted to get invested, but I didn't put in the full 20%, or I didn't max out the 60,000. The HMRC is quite nice about this. They'll actually let you look back on the last 3 years and add up those non-made contributions into your SIP or your company pension to max that out. So say you put in 0 for the last 3 years, you made over that 60,000 threshold that allows you to do the full 60,000. You could send a check for 180,000 and make that full contribution to catch up for those last 3 years. So make sure to consult on those functions, but a great way to do so. You leave employment, you end up having a whole bunch of corporate pensions in different places. This is one of the #1 phone calls that we get. You have a 10,000 pound pension here and there, several different places. You want to consolidate them. If you're not an American, you move them all into a SIP, absolutely no problem. When you're an American, unless they're sizable, it is probably more advantageous to go ahead and consider rolling them all into the newest pension, i.e. your current plan. That way, you don't have as much administration. Moving them into a SIP poses the risk that America will consider a SIP a foreign trust. Now, there's no problem with a foreign trust, right? It's just a declaration on the US side. But you want to be able to go into it with your eyes wide open. In other words, you don't want to get a bill for an extra 500 pounds from your tax accountant to do a foreign trust filing on an annual basis for the rest of your life on a small SIP. So that's where you'd rather have the conversation with your tax accountant of whether they'd consider it a foreign trust or not. If not, then it's totally fine to make it a SIP. If they do, how much is it going to cost you? And how much are you going to pull your hair out every year as you're paying that bill to have it in a SIP instead of a pension? So just awareness of those types of issues.
And another thing, Brian, to point out is that as American citizens abroad, we have to file the FBAR form for any accounts that we have that are foreign-based accounts. So if you have SIPs, if you have any kind of pension plans, that is something that you need to remember to do, to file those FBARs.
Another one of those 4-letter acronyms.
Yes.
Yeah, well, we have Nixon, we have Reagan. They're the two that put in the prefix and the FBAR, right?
Right.
Yeah, we had Lincoln that did citizens-based taxation. So 3 of the legendary Republicans. Take a guess who probably will be the 4th, and he's already put his legislation forward on what's going to be the pain in our, well, insert what you want there.
I don't know, Brian.
Well, it's already crossing our desk quite often, this question of the 3.5% tax on any removal from US dollars. I don't know if you've seen the writing on this one, Alex.
No, I have not.
So with the big tax plan that Trump's introduced, hasn't gone through the Senate just yet. If it goes through, essentially anybody removing money from dollars will be hit with a 3.5% tax. Now, the important part to note is all of us with an American passport, it won't affect us, according to the current bill. But anybody that's not a U.S. citizen, i.e. if you're going to renunciate your citizenship, come January 1st of 2026, that would be the case. If you have a foreign spouse that has money in US dollars, it would go into effect. In an inheritance that money goes to a non-US spouse, it would be hit with that 3.5%. The Trump administration wants to devalue the dollar. This is one of their ways that they're going to devalue the dollar, is getting non-Americans not to own US dollars. So I know a lot of people are fearful that the majority of their money is in US dollars. As Americans, it doesn't affect you at this point in time on this current bill. We will have to keep an eye on everything going on, which is, 10 tweets a day minimum. So we will keep an eye on these types of things as they change. The last thing we should cover is HMRC status of funds. This is a really, really odd one, and we only see this in Austria and the UK. We already talked earlier about how we don't want to own any UK funds, ETFs, or collectives, UCITS, because they end up being PFICs. Now, that means we want to have everything in the US. If we own individual stocks, absolutely no problem. If we own individual bonds, absolutely no problem. If we own individual cash, no problem. Because the UK recognizes those. But if we buy exchange traded funds or mutual funds, we have to make sure it's on His Majesty the King's Revenue Services list. It's publicly available. You can find it just by Googling HMRC qualified list. I think there's about 200 funds on there. And it doesn't always make sense. So for instance, if you wanted to buy the S&P 500, VOO, Vanguard's S&P 500, is on the list, which means you pay the lower income tax rate, income and capital gains tax rate. If you buy SPY, State Street's S&P 500 fund, it is not on the list, and therefore you pay your earned income rate, which is most likely a lot higher. So when you're buying our group of funds, i.e. our model portfolios through DF Direct, when you're buying them from any of the other 83 financial planning firms in the UK that cater towards Americans, i.e. you have a lot of support here. One of the biggest things that you're getting is a group that's making sure that your funds are qualified both in the US and the UK. Your portfolio in the US, when you first move over here, that 4 years that Alex talked about, that you have to clean everything up, if you don't clean it up and you don't have those HMRC funds, it could be nearly 50% taxes on all the gains that you take on from those funds. So very important to have that as a takeaway. Paulina's joined back in, so I think that means
that means I want to check if there's someone that has a burning question and if they want to put it in the chat, because if not, I think no. Okay, so I think that will conclude our webinar for today. If you have any follow-up questions, you can always contact us or contact me at Paulina@dunhillfinancial.com. And thank you guys, and thank you guys for joining us today. And we wish you a very good day.
Thanks so much, Paulina. Thanks, Alex. We'll see you soon.
Thank you. Bye.